Hello and welcome to this Diwali special on ET Now. I am Anisha Jain and with me Samvat Sarkar. Joining us today on our special Diwali segment, Fantastic Managers, is of course Rajeev Thakkar, the CIO at PPFAS. Rajeev, hi, thanks so much for making time and dropping by.
Thanks, happy to be here.
And happy Diwali to you and everyone at PPFAS. Expecting it to be a better year?
Hopefully, yes. Happy Diwali to you and to everyone at ET Now and all the viewers and your loved ones. Better year, I am not so sure because last year returns have been one of a kind and it's very, very difficult to better that. If we eke out a reasonably positive year in the 12 months ahead, I think that would be good.
So, low single digit, high single digit?
Difficult to say. It's a coin flip, but somewhere in that range.
Okay.
I think fixed income will be a tough competitor to equity, is my guess. Again, no one knows, but my guess is fixed income also has a reasonable chance.
So then, why you're expecting such a less return? Other than valuation and earnings being a concern at this point of time, anything else that is worrying about the equity markets?
But typically, it's valuations, right?
Okay.
So my favorite example is things like Infosys and Wipro. If you bought them in early 2000, let's say Jan 2000, in a decade, Infosys probably increased its profits from 250 crores to 6,500 crores. But the stock gave barely national savings certificate returns over 10 years. So if starting valuations are very, very high, then it becomes difficult to generate returns. So if we really look at our portfolios and the stocks that are there, all the themes that are running, how many triple digit earnings multiple stocks are there? And these are not small
Quite
cap
a few
companies.
these days.
Yeah, so that's the challenge.
But you know, you're talking about the triple, kind of PE ratio companies, and Trent comes to mind because at 5,000 we thought it's expensive, at 6,000 same thing, at 8,000 we are saying that, and now perhaps Street is factoring in 10,000. So I don't know, maybe the Street is willing to pay a price for that growth, and that's why India is still high in the pecking order.
So Nisha, whenever excesses happen, either on the upside or downside, it's very difficult to call tops and bottoms. Any investor will either sell early or will either sell a bit late. You will not catch the exact top. While buying you will not catch the bottom, while selling you will not catch the top. So you have to look at your portfolio weightages, the weightages of individual names in your portfolio. You should try positioning your portfolio in that manner. Something which is expensive can become more expensive, something which is cheap can become more cheap. You cannot prevent that, but what you can do is prevent huge damages to the portfolio when the day of reckoning eventually comes.
So then, which is that one sector where you're assigning the highest weightage right now?
So private sector banks, I think a lot of people, as Anisha was also pointing out, a lot of people have that as a consensus buy, and some of the names are available at almost pre-COVID prices, whereas profits have grown and things like that. So that's one space where I think valuations are still
as again,
attractive.
private sector banks was a consensus buy 6 months back also, but then we haven't seen much of gains coming in. Neither FI flows have come in into private sector banks. In fact, they have been the highest seller when it comes to financials in the last 6 months. So what is that one thing that has still been concerning when it comes to the private banking space?
So if there were no concerns, then you wouldn't get the valuations that you are getting.
That.
So typically the average person who's buying and selling looks at 1 quarter, 2 quarter kind of thing. The differential perception comes when you are willing to wait longer than the average person. So if people are bullish on India, if people are saying we are going to grow GDP, if we are going to have housing for all, if we are going to have so much of capital expenditure in energy transition or in shifting from fossil fuels to EVs or have roads, rails, will that not result in lending growth? Obviously, it will result in lending growth.
But in any case, Rajeev, I'll take your time and ask you some of those questions that I wanted to discuss as well. And the first one will come up for you on the screen, and that question is, which is going to be the best asset class in Samvat 2081? And I ask you that because, of course, there's Indian equities, which is our all-time favorite. Global equities in terms of China as well as US has been doing okay, and China is a great tactical trade as per many. Gold, what, 30% up this year already, and people are expecting it to go further. And of course, the interest rate cycle turning. With that context, which would you say would be the best asset class?
So asset allocation would be all of the above. So typically people would have some mix of
Yes,
this.
but what will
Yeah,
outperform?
but if I had to select in terms of attractiveness, I think B and D would be good. So fixed income securities and global equities.
I have to kind of dig deeper when it
Yes.
comes to debt as to what your view is. So then how are you looking at debt? If anybody had to allocate right now, what will be the tenure that you'll, tell them to deposit money into? India, US, where are you looking at that?
Largely India. Most Indians have opportunity to invest in Indian debt.
Yeah.
Investing abroad, especially in fixed income, is challenging with the tax collection at source and the multi-country taxation and things like that. So when bank CDs for 1 year are in the region of 7.5, that's an attractive space. Also, if someone wants to lock in money as a retail investor, RBI bonds, which on a floating rate basis are 8+%, things like that are available today.
That tells me and gets me to the next question. It seems like you're expecting the Indian equities to deliver 0 to 5% kind of returns, because if you're talking about debt, giving 7-8% and that being good enough, what would be your sense as to what the Nifty return for next year will be?
I think it will be somewhere B or C. Again, it's a guess. Around 9, 10, 11%, 12% kind of numbers. I don't expect outsized gains this year. But again, it will depend on various events, and supply is another factor to watch out for. Huge amount of fundraising is going to happen from the markets, both in terms of IPOs, QIPs, and offerings.
Yeah, and if Samvat 2080 is anything to go by, clearly there are people there to cash out. But let's go on to the next one, which is, of course, which is the biggest risk. As you talked about, there are a lot of outside factors. What within this would you call the biggest risk for the markets?
Valuations, out and out. C.
Okay, so valuations is the clear one now. Let's move on to the next one and see what that one throws up for us, because I think that one is going to be where would you allocate, which category of mutual fund will you go for? And this is interesting because it's coming from you who's been doing this day in and out. Which one is the best place?
I think small and mid caps have run up quite a bit. Thematic typically is a bad idea. I think I'll go with large caps.
Okay, so large caps is where you find the maximum amount of comfort. And let's get sector specific then. Financials, of course, you called out, so I'm guessing your view is going to be that. But do you see some sort of upside on IT and energy, or that's a bit of an avoid?
Maybe yes, IT and energy, but financials I think is the best placed.
Okay, so there you have it. That's the expectation for the full year in terms of the asset allocation, the sector which is expected to perform better, as well as what to expect from Nifty. But I think Samvat will perhaps now take your time out to help us understand what his questions are regarding the Wheel of Fortune.
Well, yes. But then as we start this, just one question that I would want to ask you when it comes from new investors' perspective, given the fact that mutual fund returns have been very strong for the last quite a few years, and that's the reason why SIP flows have also increased. But given that now market expectations are of muted returns, don't you think that would lead investors to stop their SIPs? What would your message for new investors?
So a person who joins the workforce at the age 20 or 25 will regularly invest in a EPFO for 35 to 40 years. People take insurance policies and again pay premiums for decades. I don't see a reason why SIPs need to stop based on the near-term returns. It's largely a strategic asset allocation call. A young person should definitely participate in the India growth story and keep investing in equities for a substantial portion of her or his monthly savings. I don't see that as a challenge. The worrying part is that some of the newer investors, as you pointed out, have come in and only seen rising markets. They haven't seen a fall in stock prices ever. Now, will they get unnerved with somewhat shaky markets? It's a question where there are no clear answers. We'll only know when it actually happens, and we'll see the investor behavior.
Well, then stay invested. That's what the message is. And let's now roll the Wheel of Fortune. And it's okay.
It's taking its own sweet time.
Oh, multi-bag idea. I believe you can't give an idea, but any sector other than financials that could be a big multi-bagger for the next 5 or 10 years at least.
I think let's put large and large cap funds and debt funds and hybrid funds.
Okay.
So people can buy mutual fund units and have multi-baggers over the decades.
But thanks, Rajeev, for making time and speaking with us today, and wishing you happy Diwali yet again.
Pleasure being here. Wish you a happy Diwali and happy Diwali to all the viewers.
With that, it's a wrap on this conversation. Stay tuned to ET Now for more.
If you like this video, then like, share and subscribe to ET Now.